Thank you so much for choosing my program. As the title suggests, you are now on your way to create a secondary income stream through long-term shares investing. Firstly, let's have an overview of the investment process, or what I mean by long-term share investing strategy. As you can actually see in a diagram here, you actually see two main parts. The blue part is my stock selection process comprising of business analysis, financial statement analysis, pricing analysis, and risk analysis. This is how I choose my stocks among all the stocks available. Please take note, in this process, I've arranged the analysis in order of importance, which is to say, maybe I'll find stocks that pass business and financial statement analysis but fail pricing. But definitely, I won't buy into a stock whereby they fail business and financial, but because it's cheap, I buy. In other words, I don't mind buying good stocks that are expensive, but lousy stocks that are cheap, definitely a no-no. Okay? So after going through this blue process, or how I choose my stocks, okay, I will actually have a list of stocks in my watch list. I know what to buy, but haven't buy yet. You also have to know when is the best time to buy or sell. This is where the yellow parts comes in, or what I call portfolio management, comprising of economic analysis and portfolio strategies. So basically, in this process, I've actually highlighted what to buy, and of course, some guidelines to when to buy them, when to sell them. Let's jump right into some of the details. Stock selection, the blue part. Okay, so as I mentioned, you start off with business analysis. Basically, this is what happened. You are going to put some of your hard-earned cash in shares. At least know what business they are in. Frankly speaking, long-term share investing is equivalent to starting your own business. You should have the similar rigor in the due diligence. What do I mean? So every time I buy a stock, I see myself buying a stock and entering into a business venture exactly the same. So take for example, if I buy a stock investing in a restaurant, to me, there's no different from me getting a few friends starting a restaurant together. So the way I analyze the investment is exactly the same. When I actually want to start a restaurant with my friend, what do? I have to make sure that, the food is nice, the location is good, or basically simply the restaurant can make money. It's the exact same process I have to use when I invest in a stock. The stock that I invest in, the company, okay, that restaurant, is it going to make money? Okay, is it going to have good business? And more importantly, is it going to last for the next 5 to 10 years? This is what I mean by business analysis. Or put it simply, no different from starting your own business. Okay, this is a very key point about my strategy, the long-term share investment strategy, or what it means. Look for business with potential growth in profit over long term. What is long term? 3 to 5 years. Their share price is very likely to increase if you pick the right company where profit continue to grow. And the best part is this, if the company you pick is correct, a lot of time they actually give dividends, and you pick up dividends along the way. So in short, this is my strategy, my long-term share investing strategy. Find the right business, buy whole, okay, along the way pick dividends, and of course when the price go up, okay, that is where you actually collect profits. So in short, every time you buy a stock, have an investment team. At every point in time, there will be certain sectors, certain industries doing very well or a lot better than the rest of the industry. Like for example, maybe healthcare, transport, IT, so on and so forth. So every point in time, our job is to find which sector or which industry is actually performing better. And of course, those are the stocks that we want to collect. The next part about business analysis is to understand the different categories of stocks or companies. Basically, there are two main ones. One is what we call growth stocks, whereby a company, because of the business model, has potential for higher profit growth. What are some examples of this company? Maybe one I could give you is healthcare. Think about it. Basically, healthcare business, whatever they charge, you have to pay, correct? Or you can't actually really negotiate price to the doctor saying that, oh, okay, can you have a discount? No. So technically speaking, whatever they charge, they want to pay. And if they want to increase their profit, all I have to do is to charge higher. So in that sense, this type of business, there's a higher potential for the profit to grow because all I have to do is to charge higher and we have to pay. So this is technically what we call a growth stocks. There are actually some business whereby, because again of the business model, I can't stress enough, is the business model that we're looking at. Because of the business model, their profit tends to be stable. One example I can give you is a transport company, like for example, bus services. The number of people taking the bus every day is about the same. You cannot have suddenly a lot of people taking or very little. About every day, it's about the same people taking the same bus. So in that sense, their profit is very stable. How do they increase their profit? If they increase their profit, they have to increase the fare price, which I'm sure the government is not going to allow. So in that sense, this company, transport company, because of the business model, income very hard to go up, income very hard to go down at the same time, and their profit is stable. So what they can actually do for shareholders, they can actually give shareholders very stable dividend or dividend yield. So these are what we call income stocks. Of course, whether you choose between growth or income stocks really depend on your investment objective. If you're willing to take higher risk for higher capital gain potential, of course, you should be choosing growth stock. But if you're there, you want to build a stock portfolio of passive income, then of course, your focus should be on income stock. Okay, so naturally speaking, as a long-term share investor, these are only two types of stocks that we are looking for. As you can actually see in the diagram, there is certain overlap. Hey, it's not that I've done some error. Basically, there are stocks that are both growth and income, and naturally, these are the stocks I like more. At the same time, there's one huge category of stock called none of the above. Neither growing, neither income. Okay, so of course, as a long-term investor, these are the stocks I will definitely avoid. Okay, so please take note, a lot of times, the category none of the above, the price can be very cheap, which entice people to buy. So please take note, as long as stock is no good, however cheap, the stocks don't touch. Okay, as you can actually see on the screen here, you can also see things like ETFs, REITs, and business trusts. So these are also instruments listed in the stock market, for most of the stock market, which are very good for long-term share investing as well. Whatever that's actually not listed, like for example, some stock market has warrants, CFD, so on and so forth, these are definitely not for long-term share investing. They are there for certain purposes. If you want to invest, okay, make sure you know what are they. So whatever that's good for long-term share investing is all on the screen here. Okay, that's all we have for business analysis. After choosing the right business, we have to make sure the company is financially healthy. So in this course, you will learn how to read financial statements and how to do simple and yet important analysis to make sure company is financially healthy, make sure company, when you hold for next 5 to 10 years, they don't have bankruptcy risk, or the risk of being bankrupt is actually very low. So in this course, you'll know what is a balance sheet. When you actually come to the course of financial statement analysis, you will learn what's a balance sheet, you will learn what's a profit and loss statement, and you'll know what is a cash flow statement. Most importantly, from this statement, you'll know what are some of the variables, indicators you should pick up and do certain ratio analysis to help you come with certain conclusion of the financial health of the company. Some of these ratios are like, for example, profitability ratio, which company is more efficient in making money, liquidity ratio, does the company has enough money for the coming year, or solvency ratio, can the company service the interest and repay its debt? So keep a lookout for the course, very important. Along the way when you actually read this, you will learn how to pick up numbers, do this ratio, and of course eventually, have a conclusion on whether the company, is it financially healthy, is this a company you dare to hold for long term. So I hope you can remember the blue process as we go along here. Step 1 is business analysis, followed by financial statement analysis, and of course after which we do pricing analysis, whereby we know whether the stock is cheap or expensive. Put it this way, every stock they will actually tell you, I am cheap, I'm expensive. So please know how to read them. How do we actually read them? It's actually through the various ratios and methodology you actually see on the screen here. So one of the main methods is actually called discounted cash flow. This is the method used by most professionals in determining the fair value of a company. In this course, I will just go through the concept, but also it's good to know, what does this concept entails. Okay, so something a bit difficult for you to apply, but fret not, okay? The rest of the ratio analysis, PE ratio, price to book, dividend yield, okay, after going through this course, you'll know how to apply immediately. You'll know whether the stock is it cheap or expensive just by looking at all these ratios. So PE ratio, short for price earning ratio, basically measures the number of times the share is priced as compared to the earnings. Price to book ratio, market price as compared to the book value, or basically what the accountant thinks the value of company is. And dividend yield analysis, basically answering this question, is the dividend yield attractive? So these are some tools we can use to help us see whether the stock is it cheap or expensive. Okay, so of course you will have a course right on that. Okay, next we actually have to look at risk analysis. So please understand, investing is risky. Regardless of who you are, no matter what you do, investing is still risky. You cannot eliminate risk, but you can mitigate risk, reduce risk, and of course choose among the risks. So the three main risks we're actually looking at in this course is this: company-specific risk. Basically ask yourself this question: is it likely for the business to continue for the next 5 to 10 years? Do you think that the business 5 to 10 years later still around, doing better? And the next question we're going to ask is this: what are the events to look out for while I'm holding the stock? Okay, as you know, environment change, economic condition change, so on and so forth. So you have to ask yourself, after holding a stock, what are things to look out for? When that thing happens, should I be selling my stock or should I be even adding more? So when you buy, you have to ask what are events to look out for. Next risk, which I think is a more important risk, credit risk. Does the company has a potential debt issue? Again, during the course, you will learn how do you actually calculate all these ratios, which help to determine the credit risk of a company. Okay. Then, of course, from there, you know whether the company is it likely to go bankrupt while you're holding the stock. Last risk, market risk. Is the market going upwards or downwards? Okay, so like we always believe, you have to time the market, make sure you buy correctly. Or put it this way, we believe that there's actually this invisible hand. When this hand pushes the stock market down, all the good stocks, even all the good stocks, the price will go down. So there's this hand that actually will push the market. When this hand pushes the stock market up, all the lousy stocks, the price also will go up. So you have to make sure, okay, you have to buy the stock at the right timing. Of course, we want to buy when the stock market is actually going up, and of course, you may want to start selling, okay, when the stock market is coming down. So market risk is something we need to watch out for. Okay, so we actually completed the 4 steps in selecting stocks. Once again, it's business, financial statement, pricing, and risk analysis. Haven't buy it? So the stocks that actually pass all this analysis will go into my watch list. Okay, so these are the stocks when I'm ready to buy, then I know what to buy. So of course, to see whether I'm ready to buy, ready to sell, what I look at, the yellow portion, remember, the portfolio management. So what does it entail? Firstly, we entail this thing called economic analysis. We believe that the stock market is correlated to the global economic performance. So of course, if you think that global economy is doing well, then of course the stock market will go up, and vice versa holds true. So in that sense, if I believe that, okay, the global economy is going to do well, then of course stock market go up, then what do? Actually, I dare to go into this thing called aggressive investment. Just to help you visualize what does aggressive investment mean. So let's say I got $100,000 for investment. Aggressive investment, I'll invest 100%. Okay? So of course, if I think that the global economy is actually going to go bad, market is going to crash, then of course that's why I do my divestment, which means if I got 100,000, probably I only invest, or sell out such that I only have 10% remaining. If let's say I think that the market going sideways, then probably I go into cautious investment whereby I probably only invest about 50% of the investable assets. Okay, so what will help me determine which mode should I go into? Economic analysis. So as per this chart suggests, I just want to give you a few of what we mean by aggressive investment, divestment, so on and so forth. So of course, if let's say we are the point circle in the red right now, market is bottom, expect the market to go up, then of course we'll be doing aggressive investment. I got $100, I invest $100, 100,000, I invest 100,000. Okay? So when the market start moving up, when market becomes jittery, you don't know whether is it going up or down. This is where I turn into cautious investment, whereby if I got 100,000, probably I only invest 50,000, 60,000, depend on my opinion on the market directions. Of course, when the market is high or market expected to drop, this is where we'll do divestment. Okay, so in that sense, I will start selling, and of course at this point, probably I only maintain 10-20% of stocks in my portfolio. So once again, how do I actually determine market direction? Economic analysis and portfolio management basically, answer the question, roughly how much of my money should be invested in the stock market right now, today. So of course, at the same time, it also answers this question, what are the stocks or what type of stocks you should be buying at this point in time. Take for example, if you think that the market is actually going up bull run, of course growth stocks are better. Growth stocks perform better during bull run. If you think that the market is a bit jittery on the sideways, so of course income stocks is better. Why? Okay, because if let's say for example, if you are wrong, at least you get compensated for holding the stocks from what? From dividend. You still collect dividend while holding the income stocks. So of course, REITs is also part of income stocks. So of course, something, if let's say market's a bit jittery, REITs is maybe something you want to hold. So okay, so when we talk about portfolio management, we also talk about what type of stocks we should be looking at. In short, in summary, this is my game plan. So this is a very important chart, so please pay attention to this. As a long-term investor, we believe that the next peak will be higher. So I have enough evidence to prove that the next peak will definitely be higher than the previous peak. So our game plan is this. For us to benefit, we have to do two things correct. Number one, choose the right company. We have to make sure that when we are at the next peak, when we are there, our company is still around, hopefully more profitable. And we spread out our investment. Ideally, we buy more when the market is low. So of course, if you follow my portfolio management strategy, okay, you will you tend to buy more when market is low, and of course less when market is high. So in that sense, when we hit the peak, this is where our life-changing moment will come. This is where we take our profit, and of course, a lot of times you probably have a life-changing moment, when that peak comes. So understand this. This is the game plan. Like as the title suggests, this is create a secondary income stream. It's not for primary income. How we actually get our return is really, we just plant our seed, and when the peak comes, this is where we have suddenly big change in our life because of the returns we can get. So understand the game plan and of course use the game plan accordingly. Okay, I hope I actually get you excited with what you potentially can actually get. So come on, now just jump right next into the video to start your learning journey. See you around.